Welcome! Today, we're diving into one of the simplest yet powerful project selection methods, the payback period. Whether you're managing a project, making investment decisions, or just curious about finance, this method gives you a clear picture of how long it takes to recoup an investment. Simply put, the payback period is the time it takes for an investment to generate enough cash flow to recover its initial cost. It tells you how long you have to wait before your investment starts to pay off. It's like asking, how many years will it take before I get my money back? Calculating the payback period is straightforward. All you need is the total cost of your investment and the annual cash inflow it generates. For example, if you invest $100,000 in a project and expect an annual cash inflow of $25,000, your payback period is $100,000 divided by $25,000, which equals 4 years. Let's put this into a real-world context. Imagine you own a bakery and are considering buying a new high-efficiency oven that costs $20,000. This oven is expected to bring in an extra $5,000 in revenue each year through increased production. Using our formula, payback period equals $20,000 divided by $5,000 equals 4 years. This means it will take 4 years for the extra cash flow from the new oven to cover its cost. After 4 years, every extra dollar is pure profit. There are several reasons why project managers and investors love using the payback period. Simplicity. It's easy to understand and calculate. Risk assessment. It helps you gauge how quickly you can recover your investment, which is especially useful in uncertain environments. Cash flow focus. It emphasizes the importance of cash flow, which is vital for the sustainability of any business. While the payback period is a handy tool, it has its limitations. It ignores cash flows that occur after the payback period. It doesn't consider the time value of money, meaning a dollar today is worth more than a dollar in the future. It doesn't assess overall profitability. Even if the payback period is short, the project might not yield significant profits over its lifetime. To summarize, the payback period is a quick and effective way to measure how long it takes for an investment to pay for itself. It's especially useful for smaller projects or when assessing risk in volatile markets. However, remember its limitations. Always consider additional methods like net present value or internal rate of return for a complete picture.